learning outcome statements and the topics covered within this reading lend themselves to multiple choice vignette style questions better than perhaps a guided response essay type of question, with the exception of the last learning outcome statement, evaluate the selection of a benchmark for a particular investment strategy, which is a topic that we will cover in much greater detail in performance measurement and attribution towards the end of the level 3 curriculum. So here, with evaluating the selection of a benchmark, we will mention things just very briefly, as this chapter does, but this overlaps 100% with some of the other things that we'll be doing later on in the curriculum. So, first, let's define what a benchmark is. It is used as a standard against which the performance of a fund manager is going to be measured. And the users of benchmarks could be plan sponsors. These are the major clients. So what are examples of plan sponsors? It could be the trustees of a pension fund. It could be the trustees of a university endowment fund or a charity's investment portfolio. In the private wealth management context, the plan sponsor would usually be the same person as the client that has given us the money to manage. So the plan sponsors are typically, in an institutional context, responsible for determining participation requirements, determining investment choices, contributions, and distributions, external cash flows related to the fund. And benchmarks may also be used by fund managers. These could be in-house fund managers working directly for the plan sponsors, but more commonly external fund managers. For example, in the case of a university endowment fund from, say, an Ivy League university, choosing a well-known asset manager, such as, say, Fidelity, to manage part of their portfolio. So the fund manager in this case would be an external fund manager, not working directly, not an employee of the university. So what are the uses of benchmarks? It is a reference point for parts of the sponsor's overall portfolio. So, for example, the sponsor may be a very large university endowment or, say, a pension, and part of that may be invested in, say, UK equities, so you could use a specific benchmark to track the performance and measure the performance of your UK equity investments against, which would be a part of your overall portfolio. It could also be a way of conveying instructions. Conveying instructions either from the sponsor to the fund manager, or conveying of instructions to any other oversight group or consultants in terms of how the fund is being managed, what is the fund's strategy, or what we would like the fund's strategy to be. So if I say that the benchmark that I would use for this part of my portfolio is a sub-investment grade value-oriented fixed income index, that means that's exactly how I would want those monies to be managed. It could also be used to identify and evaluate portfolio risks. If a benchmark is well chosen, then the benchmark would have a lot in common with the actual investment portfolio, which means that the exposures to the various risks within the benchmark and the portfolio would be quite similar as well. We take a look at, most commonly, benchmarks for evaluating and attributing past performance. The difference between the two, evaluating past performance, is simply taking a look at what the past performance of the fund versus its benchmark has been. This could be done using various different mathematical methods, which again we will cover in a later reading. We may have to make risk adjustments and so on as well. And performance attribution is all about finding the source of the outperformance or the underperformance of the fund compared to the benchmark. What was that due to? Was that due to asset allocation decisions? Was that due to security selection decisions? Was that due to excessive risk taking, and so on? And we could then make decisions as to whether the managers have done a good job, whether the managers are skilled managers in managing our money. In many cases, fund managers that consistently beat their benchmarks and outperform their benchmarks use this as part of their marketing. In the case of exchange-traded funds that track indices, the index's name as a benchmark in this case will be used just as commonly as the fund's name. And it is also important to remember that in most jurisdictions, funds that are regulated funds have to have chosen benchmarks to comply with rules and regulations. The reading very briefly mentions the desirable qualities of valid benchmarks, and we list those here, although there's also an easier way to remember those, which you may have seen or heard before in other courses. Samurai, specified in advance. Appropriate, measurable, unambiguous, reflective, accountable, which is the same thing as owned, and investable. So if you take a look at the CFA books, and some of our end of chapter questions about this will relate to, well, here is a client, here is an investor, and these are their requirements, and this is what they have chosen as their benchmark. Evaluate whether this is a valid benchmark or not, and to evaluate whether a benchmark is a valid benchmark, these are the criteria against which we should judge the benchmark choice, keeping in mind that no benchmark is ever going to be 100% perfect. So, what are the various different types of benchmarks? We categorize them into 7 here. Absolute or target return benchmarks are chosen mostly by absolute return funds, market neutral funds, where they promise a return that is at least equal to or above a preset level. Now, these may be absolute returns, or they may be compared to a market reference rate like Euribor, LIBOR, and so on. Another one that we take a look at is manager universe, peer group benchmarks. Broad market indexes, which a lot of times people think as analogous to benchmarks, but there is usually a very small set of investment situations, funds, for which a broad market index would be the best benchmark. Style indexes, which are a much better choice. Factor model-based benchmarks, which are based on regression analysis and measuring sensitivities used to those factors. Returns-based benchmarks are very similar to factor model-based benchmarks. They also use regression analysis, but they use more advanced regression models to make sure that the coefficients that are measured all add up to 1. So we'll talk about that in more detail in a second. And then custom security-based benchmarks, which could be asset-oriented or liability oriented. So let's take a look at these in more detail. First, absolute or target return benchmarks. So these may be stated, the benchmarks may be stated as an absolute target return, 6%, or they could be based on a reference rate, like we will try to give you Euribor plus 200 basis points. And these are very commonly used for market neutral funds, long short funds, absolute return funds as they call themselves, that would not be tracking, or that would not be taking many risks like, for example, a broad market index would do. They try to eliminate most systematic risks but still be able to give us a relatively high return year after year. So this would be the best possible benchmark for those. A very commonly used benchmark against which managers are going to be judged are manager peer group benchmarks. So we form peer groups of fund managers by selecting other fund managers that invest in the same asset class and have similar investment approaches. And the manager's performance is then compared to the median performer within that peer group. This is very often used to evaluate hedge funds because there are no market indexes or style-based indexes and so on that do a very good job of matching the management style of many hedge funds. Although there may be multiple hedge funds that follow roughly similar strategies. So this is used very frequently to evaluate hedge funds. But also, if you take a look at many consumer-oriented investment publications like Morningstar and so on, a lot of investment magazines, they also use peer group comparisons to help retail customers select what they believe to be the better than average fund managers within a selected asset class and within a selected investment style. For example, growth-oriented equity investments. Next one up is broad market indexes. What we mean by broad market indexes is, these are commonly going to be stock indexes or possibly fixed income indexes that have many constituents, like, for example, the S&P 500 index. Which contains the 500 largest companies in the United States by market capitalization. The advantage of using these as benchmarks is that they are very well known. The benchmarks themselves are automatically calculated, they are readily available, and they are very easy to understand in terms of how they've been put together by clients as well as the fund managers. However, at the same time, they got quite a few disadvantages in that there are very few actively managed funds whose investment styles and portfolios are best reflected by a broad market index. So they are most appropriate typically for passive index trackers. So if, for example, you are an index tracker fund trying to track the S&P 500, it is of course natural that the best choice for a benchmark for you would be the S&P 500 as well. But for active funds, it's rarely the case that a broad market index would be the best benchmark. Style indexes are much better compared to broad market indexes. These are created by the same companies as those that put together the broad market indexes, like the Dow Jones Company, like the FTSE Company, and so on, but they have narrower definitions of specific investment styles like value, growth, growth-oriented value, and a lot of sub-styles within that. Now, the problem is, how do you determine whether a particular security is a value stock or whether it's a growth stock? Well, that's done usually by assuming that asset characteristics like key ratios are the primary determinants of performance of securities, which means that the way in which securities are put into a style index is rule-based. And that may not necessarily reflect whether many fund managers that are also, say, managing within the same style, growth style, would agree with those rules. However, compared to a broad market index, for many actively managed funds, these would be better choices as benchmarks than broad market indexes because at the very least they would better reflect the fund manager's style of investment. We then move on to quantitative benchmarks, and there are two of these that we mentioned. The simpler of the two is a basic factor model based benchmark. So here what we do is we use regression analysis to measure a portfolio sensitivity to one or more factors. For example, the CAPM model, where we use a broad market index as the single variable, is an example of a factor model based benchmark. The sensitivity that we would measure in the case of the CAPM model would be the beta. But these are more often than not multivariate models, so there will be more than one market index and other key variables like financial ratios that are factors here. So one factor could be, for example, the S&P 500 index, another factor could be, say, the Wilshire index, and so on, and another factor could be the price to book ratio. So we then measure these coefficients, these slope coefficients or sensitivities, using regression analysis. So we measure the sensitivity using historical observations of these factors, the indexes, the ratios, and so on, against the historical performance of the portfolio. We measure those sensitivities, and that helps us not only determine future predicted returns based on what we think is going to happen to these factors, but also it helps us identify the risk exposure, i.e. the sensitivity of the portfolio to these various different risk factors. Now, if you are doing Sharpe style analysis or a returns-based benchmark, what we do is we limit the factors that we use in the regression analysis to various indexes rather than indexes and ratios and other key variables. So all the factors that we measure sensitivities to would be various indexes, market-related factors. And we use special, more advanced regression methods to make sure that these sensitivities are all non-negative and the sum of these sensitivities add up to 1. So that would allow us to make a prediction, for example, saying that roughly 30% of the variability of our returns are dependent on index 1, and 55% in index 2, and 15% in index 3. The last one that we mentioned is custom security-based benchmarks. So these are custom designed benchmarks that are going to be best indexes, that are designed as valid benchmarks only for specific portfolios, only for specific funds, and not for anything else. So these are formed by selecting only those securities that are consistent with the manager's style and mandate. Another name for these is strategy benchmarks. Now, these are typically, the first two lines that we're talking about refer to asset-oriented custom security-based benchmarks. You can also put together liability-oriented custom security-based benchmarks. These are more appropriate for those portfolios that are managed with the main purpose of meeting specific future liabilities, like the portfolio for a defined benefit pension, like the portfolio for a life insurance company, and so on. So the idea here is we measure the factor sensitivities of the liabilities. We measure things like the duration, the interest rate sensitivity, and so on of the liabilities, and we then measure the performance of the asset against a benchmark that has been formed based on those liabilities. We now move on to market indexes. We mentioned earlier on that it's quite rare that a broad market index would be the most appropriate, the best benchmark for a particular fund, especially if it is active managed. But this reading also does mention quite a few things about market indexes. So why do we have market indexes like, for example, the FTSE 100, the S&P 500, the Sterling Bond Index, and so on? Well, they could be very useful as asset allocation proxies. So, for example, if we're trying to run simulations that will help us determine what proportion of our money are we going to allocate to UK equities, and what proportion of our money are we going to allocate to government bonds, and what proportion of our money are we going to allocate to Eurozone equities, and so on, we could use the Euro Stocks Index as a proxy for Eurozone shares. We could use the FTSE 100 as a proxy for UK shares, and so on, and help us determine the ideal proportional allocation to different asset classes. They are also useful for investment management mandates. So, for example, we say, well, when we give a mandate to a fund manager, we could say, well, this is the index against which you are going to be judged, which ensures that that fund manager will then pick a portfolio that is broadly based on that index, based on his selection of the better than average or worse than average stocks being left out or being overweighted or underweighted within the portfolio. They can also be used as performance benchmarks. more on that later, but we already mentioned that it is quite rare that especially for an actively managed fund, a broad-based market index would be the best choice. They could be used in portfolio analysis, try to identify the various risks of portfolios, gauges of market sentiment, which was the original reason for the invention of the very first stock index in the world, the Dow Jones Industrial Average. It allowed the index users to take a look at what is happening to the whole market rather than analyzing every single security one at a time. And they have also become a basis for a whole variety of investment vehicles that are index tracker funds, passive funds.